DBS earnings just came out and the earnings were so amazing which might set the stage for the other two banks. When the earnings came out, it was good with surprise announcement that caused the share price to increase by 7%. Congratulations to the shareholders and let us go through the results to see why. DBS Bank continued to outperform analyst expectations and even for my estimations. This quarter, both interest and non-interest income came in fantastic. For DBS, their ROE increased to 18.8% up from last quarter at 18.2%. ROE is return of equity, which is a very important parameter that shows the profitability of the bank. Of course, the higher it is, the better, because this will potentially result in higher dividends for shareholders. Total income continued to rise 11% year-over-year to a new record high of 16.8 billion, mostly due to the growth in commercial book and market trading. Like I mentioned in my previous analysis video, one of the main factors that will drive the growth of Singapore banks is because of Singapore's stability. With the world's uncertainty, more money will flow into Singapore banks as they are banks that are considered a safer haven compared to other markets. For banks, net income usually comes in two areas. First is the interest income, followed by the non-interest income. Interest income is usually stable if interest rate is stable. The income comes from the interest they earn from loaning money. Non-interest income is essentially the other parts of the business that the banks earn from, such as asset under management and fees income. They tend to be more volatile, but the good thing is that they are not interest rate dependent. So the net income for this section does not get affected if interest rate drops. If we look at their net interest income, it's quite stable with net interest margin consistent at 2.83%. Overall net interest income increased slightly by 3 million. As the Federal Reserve cuts interest rate, banks with good management will start to adapt to hedging their interests. This reduces the interest rate sensitivity of their loan, which means that when the Federal rate cuts interest rate, their income will not be affected as much. The management has been smart in hedging their income, which can be seen from the last few quarters' stability results. One of the ways to compare will be to see the next UOB and OCBC earnings to see how their net interest income are being affected. If we see their non-interest income, this is one that I have been emphasizing that will make the difference for the banks. If we see their wealth management, it continues to grow with 17.5% increase quarter over quarter and 55% increase year over year. This is an insane growth, and with more money flowing into the banks, it will allow banks to earn more through fees and investments. This is why their non-interest income increased by 14% quarter over quarter from 1.88 billion to 2.15 billion. This is a fantastic growth with 21% year over year as well. Next, cost to income ratio measures the efficiency of the bank's operation. The lower the ratio, the better. With the total income increasing by 5% Q over Q to record highs, while the expenses increase 4% quarter over quarter, the cost to income will drop because the rate of increase in expenses is slower than the rate of increase in income. Therefore, even though expenses increase, their cost to income ratio has dropped from 40% to 39%. With interest rate coming down, the safe yield from different assets will drop. For those with ideal cash that wants a higher yield, Momo Cash Plus is definitely a place you can consider putting your money in. This also supports my channel by using my link. It guarantees up to 6.8% yield for the first 30 days. That is higher than some of the dividend equity in Singapore and not bad for a short-term return. These funds can also be redeemed with no lock-in periods. Existing users will also get to enjoy the promo by putting in fresh funds of at least $10,000 and maintaining it for at least 60 days. For new users to Momo, there is also a starter promo kit for you. By depositing $100 and making just one buy trade, you will get $20 cash coupon. Similarly, if you deposit $3,000 with 3 trades, you will get stock bundles worth $70 with fractional shares from stocks such as Apple, Nvidia, Tesla, AMD or Microsoft. Making $10,000 deposit with 8 trades will get you $210. So let's start your investment journey with Mumu and sign up with my link today. Banks can earn a lot through loaning money, but they have to lend to the correct borrowers so that the borrowers can pay them back the interest. NPL percentage, which is the non-performing loan, essentially measures how much loans might not be able to pay back or default. The higher the ratio, the more riskier the bank is. However, for DBS, the non-performing loan is consistently well, dropping from 1.1% to just 1%. Next, CET1 ratio is important as they are cash or stocks which the bank can easily liquidate to use in the event of a crisis. Tier 1 is the main bulk and should normally be more than 10%. Singapore banks tend to be way above this benchmark. DBS this quarter came in at an insanely high value of 17.2% with additional Tier 1 of 0.7%. If we include both, the Tier 1 ratio is at an insane level of 17.9%. However, this huge increase was due to the computation per Basel III international standards used to calculate this CET1 ratio. But this also solidifies how solid DBS is as a business and how much cash they have as a safety net. One of the most outstanding factors that resulted in their share price increasing by 7% was due to a new share buyback program that they have announced for the very first time. Share buybacks are quite similar to dividends. Instead of giving cash to shareholders, they are buying back their own company shares and cancel them off. Let's take an example that if you're holding 1 share out of 10 shares in a company and the company buy back 1 share from the open market, the remaining company shares will be 9 shares. This makes your 1 share out of 9 shares more concentrated and more valuable. This is a common practice in the US market, which is why their companies' share prices increased by a lot throughout the years. With this share buyback program, this meant that the return given by DBS is way higher than just 5.1% of dividend at the current share price of $41.70. Moreover, this share buyback program will only reduce their CET1 ratio by 0.8%. And this will mean that they have still a lot of capitals to either use it for growing of business or reward shareholders. This is a fantastic move by the management as this rewards shareholders, making the banks more attractive. With the strong earnings, DBS is surprisingly doing better across the board quarter over quarter, with non-interest income being at a higher margin of 37% this quarter. At the same time, ROE has increased while the CET1 ratio capital continues to increase as well. So what are the things that make these DBS results so good? First, the increase in the non-interest income would mean that the bank has less dependency on interest income. This is good because this meant that as the interest rate drops, DBS total income will not be affected as much. Next, the management has consistently talked about stabilizing their interest income sensitivity. This will mean that their interest income will not be affected as much due to the fluctuation from the interest rates. This can be seen from their stabilizing interest income. Next, DBS is still achieving a very high return of equity that is much higher than both OCBC and UOB. The higher the increase, the better, because this means that DBS will have more capital for growth or reward shareholders. Lastly, with the high CET1 ratio, this means that they have a lot of capital which they can give in terms of special dividends, or will have no issue increasing their dividends next year. With such a strong earnings and DBS willing to reward shareholders, I'm very optimistic for the Singapore banks in the long term. Thank you so much for watching. Please support the channel by hitting the like, subscribe, and comment on how you feel about DBS earnings. Thank you, and I'll see you in the next video.